I think the US consumer's walking towards a cliff, basically. They're running out of cash. If you look at excess savings, they've been run down quite hard. If you look across the income quartiles, the bottom 3 or 4 income quartiles are under pressure, probably spent all those excess savings in negative territory.
The bottom 3 or 4 quartiles. How many quartiles do you have if there's 4?
Well, quintiles, I meant, obviously.
sorry to be a bit...
I was interested to see if you were awake.
Sorry to be a pedant on... Yeah, the bottom 4 quartiles, they're under pressure. The rest are fine.
It's a subtle way of slipping things in. So you've got all that. I mean, and of course, retail sales have been quite strong for the last few months. Everyone gets quite excited about that. But actually, if you look at what's going on, people have been the household savings ratio has been run down, and in fact, real income growth has been negative for 3 months. So it's not quite all good news. I mean, quite the reverse. I think there's some real challenges coming for the US consumer.
Yeah, Chris, is it a case of their consumer going down towards this cliff, as you point to, perhaps a little bit blindly? And I say that just because there's this clear sense then that, hey, wait, the US is doing okay. Things are actually fine. The jobs market is not as weak as one expected, but the highest level in 30 years of auto owners in the US having their car payments in arrears, the highest in 30 years. So clearly there's still a high amount of spending, and they're going to have to suffer those credit losses for quite some time, aren't they?
There's a lot of challenges, and we see at the margins the consumer under a lot of pressure. And in fact, the labour market's under a lot of pressure as well. There's this, I mean, we had a good payrolls month, but if you look at a lot of the indicators of where the labour market's like to go, a lot of them are fraying at the edges. They're quite soft. You look at the Kansas City Fed Labour Market Conditions Indicator, that's rolled off quite meaningfully, which generally then the labour market follows a few months later. So, yeah, I mean, I think the consumer's fraying at the edges. You see the pressure at the margins, and we're going to get to the point in the next few months when I think the labour market starts to deteriorate more meaningfully, and that'll kick-start the recession when we get there.
What does that mean for the stock market, Chris?
Well, the stock market, I mean, it's interesting. I was listening to your last segment. I mean, I think leadership probably is changing in this stock market. I mean, tech's been under a lot of pressure since July, and I think the stock market's struggling to really sort of know exactly where it wants to go. I mean, from our point of view, though, I can see a bounce for a month or two. It's quite beaten up. You know, market's been coming down since July. But I think net, you want to be underweight equities if you're looking beyond the next few months. Strategically, particularly the US equity market's too expensive. It's overvalued. You know, the US market's actually...
Is it ex-tech?
Well, it's not ex-tech, but, you know, the point is... Sure, there's pockets of value everywhere, absolutely. But the US in aggregate is overvalued. Sure. Tech's overvalued. I mean, the point is 7 stocks are a seventh of the global stock market capitalisation. You know, 10 years ago, they would have been 5%. They're now 16, 17%. And the global stock market is a reflection of global corporate profits. So the US is the most expensive part of the global market. If you look at the equity risk premium, it's re-rated this year. So, yeah, I mean, I think the US is in for tough times.